Today we discuss the new DOL rule and if it's a good time to trim Amazon.
This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, April 29th, 2024 edition of InvestTalk. Happy Fed Week to everyone out there. We only have one more trading day left in the month of April. And to celebrate all of that, we have Luke Guerrero back with us. Thanks for being here, Luke.
You know, Justin, I feel like it's been a while since we've done this show together, so it's good to be back.
Yeah.
In the same room, so to speak.
Always good to have the nice banter back and forth. Never hurts, right? Well, I know a lot of our listeners love that. So hopefully we have a great show today, and I do think we do. We have so many great topics to cover, and we have tons of data and perspective developed with over 20 plus years of investment experience to help guide you through these new markets, this different economic environment. We have so many topics to kind of go over today that kind of color this new regime that we are in. Higher rates. This is one thing I'm excited to talk about today. We had the Fed meeting. Everyone's clamoring for lower rates, but will that actually be good for the economy? We're going to talk about that. But we're also going to run down the show topics, the rest of them for the day, as well as the market performance. But as usual, Luke, we're going to hit our first caller question now.
Hi, I'm calling today about Caterpillar, ticker symbol CAT. I own this stock and I'm up a good amount. So wondering if you think it's time to trim a little bit, or how you feel about the sector, maybe Caterpillar or both Deere as well. Caterpillar had its earnings and the stock dropped a little bit. So just want to see what your take was and what you think about the future. Thank you. Bye.
All right, looking at Caterpillar, pretty much the largest producer of earth-moving construction mining equipment out there in the world, $175 billion market cap. Luke, this has been up. The caller said they're doing very well, but I think people tend to trim their winners a little too quickly. So that's my first inclination here, because this is in a nice uptrend. Relative strength is 91, and that's after a recent pullback in markets and earnings that disappointed, but it's been rallying since that disappointment. So the technical picture is fine, although earnings growth is expected to slow this year and next year. Only 2% growth this year and 5% next year. But a mid-teens P ratio, that seems pretty reasonable to me in a good business. What are you seeing?
No, it's a great business. They recently beat on earnings. Like you mentioned, their profitability has been improving. Their cash flow has been improving for the past couple of years. I would say that one thing that I would consider when holding this company and not starting to trim a little bit is, and it's something you and I are going to talk about a little bit more in the show, a little later in the show, and that is where the path of rates is going to be. And so, there is a non-zero chance now, according to the market, that rates may go higher. And so a company like this that's incredibly capital intensive, and their customers are also companies that are incredibly capital intensive, that could hurt revenue. You even see it in projected revenue growth for this year, actually supposed to make less in terms of revenue, though slightly better on the profit margins than last year. It seems like their growth really is slowing a little bit. So that's certainly something to be concerned about. Lastly, I tend to say this a lot. No one everyone broke taking profit. So I don't think it's a reason to sell your whole position, but if you're up quite a bit, trim a little bit.
Yeah, I think a rebalance at this point is not a bad idea, especially considering we're probably heading into a bit more choppy of a market environments for the balance of the year. But with that being said, I love the business. Return on equity is 60%. Return on invested capital, 20%. It does have some debt in its balance sheet, but not nearly enough to really worry about. Times interest earned is 117. So you're perfectly fine there. And then its business is, I think, in the crosshairs of so many great long-term trends, and that is, reshoring and manufacturing. That takes a lot of earth-moving equipment in order to, grade the land and build the actual facilities. And then you're talking about mining. The value of raw commodities continues to go up. You see copper breaking out, gold breaking out, and that incentivizes mining activity. It makes it more profitable, and therefore you're going to need more Caterpillar machinery. So I think this is a solid name. I wouldn't be quick to sell much, if at all. But a prudent rebalance and never hurt anybody. Okay, thanks for the call. Let's go to Tirda in San Jose, looking at NDX. So is this the NASDAQ index? Is that what you're looking at? NASDAQ 100?
Hello. I'm actually looking at Masco Corporation, MAS.
Oh, MAS. Okay. Yeah, Masco. This is a name we actually own for clients. They make a variety of home improvement and building products. And, one of the reasons we own this is not just because it's great business. Its profitability is very solid. A return on invested capital about 30%. Return on equity is extremely high. Return on assets at 17%. So everything looks good there. But I like the secular trends. You just think of the average homeowner that has those golden handcuffs, 3% mortgage, and they can either trade in their home and their mortgage for a new one, or they can keep their mortgage, stay in their home, and maybe remodel the current home. Okay, and so that's what we're seeing is a higher propensity for people going out there and doing DIY projects, remodeling your home, etc. They own brands like Delta Faucets, and so they sell shower heads. They have a paint. They have paint and coating under the Bear and Kilts brand. So it's just a very, very quality, well-diversified home improvement business. And so this recent pullback, I think, is an opportunity to pick up shares. What are you seeing, Luke?
Yeah, nothing really to add from a fundamental side, just to emphasize the point that you made, which is, people have been saying for some time that interest rates are going to go down and mortgage rates are going to go down because of it, but mortgage rates are peaking back up again. So the reason why this company does well is certainly still going to be the case for the foreseeable future.
Yeah. That was Masco. MAS is the symbol. Now, Luke, we have a lot of ground to cover over the next 40 minutes or so, and our main focus is in regards to the final fiduciary rule and how it clarifies when financial professionals must act in the best interest of their clients. This is so important because so many people focus on that. They focus on, they don't focus, on the role that a financial advisor is taking when they're giving advice. So we're going to look at that rule and how that might impact the market. We have some other topics about higher interest rates and whether that actually impacts the overall economy and how it does, and a few others as well. We have some voice bank questions. One is on Graco, as well as rolling a 403b to a Roth IRA, and of course some questions from our YouTube channel. But ultimately, this hour is for you. So we're going to a short break, but on the other side, we'll talk about whatever's on your mind. So give us a call at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors. All right, let's take a look at the market for today. It was the first day of Fed week. We have the Fed meeting kicking off tomorrow with an announcement on rates on Wednesday. There is a nearly 99% chance that the Fed will do nothing on Wednesday. But per usual, it's not about what they do. It's usually priced into markets. It's about what they say about future path of policy. And what's interesting here, Luke, it's not just about that future path of interest rates, but it's also going to be about QT and then the wind down of QT, and then what's going to happen with the Treasury quarterly refunding announcement. That's going to be big as well. They can issue more notes or bills. If they start to issue more notes, that's going to pull liquidity out of the market and maybe precipitate a broader market pullback. If you get more bills, shorter term duration securities being issued, that's not going to take a lot of risk onto people's or corporations' balance sheets, and therefore that improves liquidity. So a lot of factors to look into for this upcoming Wednesday. So it'll be very interesting to see the market reaction. And it probably take a couple days, probably by the end of the week, for this to all settle out. And on top of that, we have earnings season. And we still have, I think, Apple this week, if I remember correctly. Yeah. So it'll be very interesting to see how that plays out. Now let's play another voice bank question from 888-99 chart.
Hey, I was trying to reach Justin or Luke. This is Andrew from Atlanta. I'm calling about the following ticker symbol, GGG. That's Graco Incorporated. I've held this stock for a while, and I saw that it's just fallen. I went ahead and picked up a few more shares of it. I'm curious if you could check the fundamentals on this. How does this stock look going forward? Big fan of the show. Thanks, guys. Have a great day.
All right, looking at Graco, and this is another name that we like, and we just recently started buying it for clients on this pullback. And what they do is they manufacture equipment used in managing fluid, coating, and adhesives, and their applications for mainly industrial processes. They're out of Minnesota. It's about a mid-cap name, $14 billion market cap. Very little debt on its balance sheet. Actually has net cash on its balance sheet with return on equity at 23%, return on invested capital at 22%. So definitely this is a good buying opportunity on this pullback. And it is at to some support around 82. The major support is going to be, however, down around $79 to $80. So that will be major support. We'll see if it gets there, but it's currently at some nice support right now. All right. Luke, let's pivot over to our main focus point today, and that is in regards to the fiduciary rule. And this is a follow-up from the 2020 rule that governs a lot more actions that come out of come with financial advice. And this is coming from the Department of Labor, okay? And this is covering mainly. It's going to cover mainly two types of investors, or help two types of investors. One will be those small retirement plans. So if you work for a small business, your company only has a handful of employees, maybe a couple dozen employees. You don't have a lot of participants in your 401k plan. Typically, those plans have high fees, and then those that will roll their retirement assets into fixed annuities. Now, let me back up before I dig deeper on those 2 points, because it's very important to understand that not everybody who calls themselves a financial advisor is acting in your best interest, okay? Oftentimes, you are speaking to somebody that is more of a salesperson than an advisor. If they are pitching you a mutual fund, especially if it is an A-share mutual fund, meaning it has a load of some kind, maybe a C-share mutual fund, anything that has some sort of a load, you are probably talking to a salesperson. You're not talking to an advisor. You're talking to somebody that just knows how to spew the talking points. They could not tell you how the portfolio is constructed, why it's constructed a certain way. They are simply selling you this fund with some broad talking points. That's it. And the Department of Labor is trying to crack down on this. And they're trying to really define, okay, who is wearing that fiduciary hat, meaning those advisors are acting in the best interest of their client versus those that are acting as a salesperson. Okay? So after the break, we're going to dig into the details a little bit more and help you understand why this will affect certain subsets of the investor class. Okay? Now we're moving into a break. Still time on this podcast to tackle your investment questions, so I encourage you to give us a call at 888-99-CHART.
Hey InvestTalk community, Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast.
Now, before the break, I prefaced the main focus point, and that is in regards to the new Department of Labor fiduciary rule that came down the pipe. And this is adding on to the 2020 rule that covers a much broader array of actions, such as advice for traditional investments, variable annuities, in registered index-linked annuities, and so this new rule really only covers those two sets of investors. Like I said, small retirement plan investors, as well as those who are rolling money into fixed indexed annuities. Now, mainly this is going to impact those smaller retirement plans. The average cost for workers covered by small plans would drop probably to 75 basis points from 93 basis points before. And mainly this is because think of your average plan, small company, 5 to 10 employees, and there's not a lot of scrutiny on these plans. And there's not a lot of people holding the executives' feet to the fire on making these plans better. So over 20 million people are covered by this, and it's shown that small plans have a much higher range of fees, which suggests many of them pay unnecessarily high fees. They have mutual funds that have, expense ratios well over 100 basis points on average, and that's an issue. When you have these plans that go into these small investors 401ks, they don't know any difference. Luke, there are a lot of plans, not a lot, 5%, about 5% of plans whose average expense ratio is over 200 basis points. What do you say
incredible.
to that?
I mean, it's frankly incredible. I mean, you nailed it when you mentioned the cost savings here. It looks like the new rules expected to save retirement plan participants $55 billion in fees over 10 years. And that's because, like you said, that 2% or whatever your fee is, it compounds. Yeah. So that's money that's being taken out year over year, year after year after year, and doesn't have the opportunity to have the effect of compounding benefit investors. So, generally, unfortunately, I think most of the financial, or not most, but there's a section of the financial services industry that tends to be a little predatory on people that don't know as much as they do about the products that those people are selling to normal investors. So I think this rule goes a step further to help some of those smaller retail investors protect themselves against the predatory behavior that can lead to some pretty terrible consequences in terms of their long-term financial goals.
Yeah, and most of those small plans are the ones that fall prey to those predatory practices. And the new rule and requirements around prohibited transaction will result in a lot of these plan fiduciaries examining those fund lineups and bringing those fees down. Now, the other set of investors that will be impacted are those that roll their retirement plans into fixed indexed annuities. And the main reason this is going to help is because there aren't explicit fees that these annuity buyers pay. But what they do pay are what are called credited interest rates, which lower their overall returns. So basically, the fund company, the insurance company, gets credited back returns over time, and that is effectively a cost to the investor. And so that's going to need to be disclosed, and a lot of those fees will be surrendered. And so overall, it's a good thing. Can't complain. Finally came down the pipe, and it's getting closer and closer to most advisors, quote unquote advisors, are now going to be fiduciaries, and that's certainly a good thing. Now let's go check in on our friends over on our YouTube channel. And every day we receive new finance and investment questions from the comment section of our YouTube channel. And here's one that came in recently. Jim Leahy says, thoughts on VICI properties, VICI, VICI properties. And Luke, this is a REIT that operates mainly on the Las Vegas Strip. And I believe they just made a recent purchase. Was it of Caesars? Remembering correctly?
No, it was really so the company was formed from a spinoff of Caesars.
Okay.
Caesars Entertainment Corporation as a part of the bankruptcy reorganization. So they actually own 54 casinos, hotels, and racetracks, 4 golf courses, and 38 bowling alleys around the U.S. and Canada. And looking at the company, they have relatively low debt, especially for a REIT. And the price performance has been where you'd expect REITs to have been going over the past year, couple months, right? Because REITs tend to do well in 2 situations. One is interest rate certainty, the path of interest rates, and the other is a decrease in interest rates. That being said, we hold VICI for clients in one of our strategies. We like VICI. I like VICI. Their times interest earned is 4. They have a pretty good moat in terms of the money that they're bringing in to pay off that debt, and I think they have a lot of room to run when things start to turn around and there's more certainty within the market.
Yeah, and they aren't exposed to office.
No, yeah, that too.
Exactly, and if consumers are still heading to racetracks and casinos and golf courses, their properties will continue to do well. So,
which tend to be the things that people do regardless of if the economy is doing well, right?
Yeah, it's true. And so that's why, in the REIT space, definitely VICI is one of the best. Now, on the next Invest Talk, we'll look into the story. Why it matters that large growth stocks are overvalued. Simply put, valuations are the best predictor we have of future returns, and the longer the investment horizon, the larger the role in valuations. That story tomorrow, but for now, I'm Justin Klein with Luke Herrera, and we are ready to take your calls at 888-99-CHART.
Did you love today's Invest Talk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation. Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
From New Jersey, longtime listener. Thanks for everything you guys do. I'm interested in moving my 403B over to a Roth IRA. I know that you guys have talked about this before, but can you just explain that process once again? And then if my wife and I file jointly, would I be then able to open up 2 Roth IRAs, one for me and one for her, if we still fall under that annual income? Again, thank you so much, and I look forward to hearing your response on the next podcast. Bye.
Well, the answer is very simple. Yes, you can roll that 403B into a Roth IRA. However, all of that amount that you roll into a Roth IRA will be taxable income to you in that particular year. So what I would encourage you to do is probably roll it into a traditional IRA, no tax consequences. And then what you can do are Roth conversions and do that piecemeal at a time. That's something you probably want to plan out with your CPA. probably I don't know what the size of those 403bs are. Maybe they're small and maybe it's not a big deal. But if they're hundreds of thousands of dollars, hopefully, then that's a big hit to your income. Big increase in your income for the year. It's going to push you into a higher tax bracket. All things you typically don't want. But you can roll it into an IRA and piecemeal it over time into that Roth. And then yes, you can open up a Roth for you and your wife and contribute for both of you, even if she's not working and you both make, over the amount you're contributing, or your income for the year is over the amount you're contributing. So I think it's a good idea, but definitely talk to a CPA before you do that so you're not hit with a huge tax bill. Anything to add, Luke?
Nope, nothing to add. I think that covers it.
There you go. All right, let's talk a bit about interest rates. It is Fed week, and everyone is wondering, when is the Fed going to cut rates? But there's a new line of thinking that, frankly, I tend to agree with. I know, Luke, you may have a little bit different of a viewpoint here, but everyone thought that higher interest rates meant, hey, the economy was going to slow, we were going to go into a recession, everything's going to go to hell in a handbasket, and really the opposite's happened, right? The economy continues to hum along. And in fact, the economy is stronger today than it was when the Fed started to raise rates. And so the new argument is that there's a very simple reason why, is that Americans are now earning a large stream of income from their savings, investing that in money market accounts, treasuries, etc., the highest level they've seen in 2 decades. And now, because the treasury market has effectively doubled in 10 years to over $35 trillion, that means that it translates into higher debt payments that go into the pockets of Americans and investors. And all of this goes into stimulating more spending. And on the flip side, when it comes to higher interest rates, there's a small amount of consumer debt. If you exclude mortgages, which are typically fixed, there's only about $5 trillion in consumer debt out there. And yes, that is impacted by higher rates. But U.S. households receive income on more than $13 trillion of short-term interest-bearing assets. So the variability of that is very high, right? Interest go from 0 to 5. People are earning 5% now on $13 trillion. And on that $5 trillion, yes, it's moving up. But net, there's about a $400 billion difference in total, in positive total, right? In net total going to U.S. households. And so that's why the consumer remains relatively strong. So I think this makes total sense. They have fixed mortgages, the vast majority of people do, and their incomes are going up because of inflation, raises, as well as the income coming from their savings. What say you, Luke? Do you buy this as a reason for the economy remaining strong?
Yes.
Yes. Okay.
No, so I mean, more to add there, but yeah, no, I think oftentimes people say this time is different, and I think this time truly is a little bit different in that you have a situation where a generation and the generation after them that has most of the wealth in this country was able to buy homes at incredibly low interest rates, locking in most of the debt burden at a low rate, meaning interest rates affecting a rise in interest rates will not affect them. You also had a pandemic that forced some of the largest companies on planet Earth to hoard a bunch of cash, about $1 trillion in cash from 13 non-financial companies in the S&P 500 in the wake of the pandemic. And so when you have most of the debt burden of consumers being not affected by interest rates, you have corporations that are hoarding cash that are now paying higher interest rates, which allow them to reinvest in their businesses using that. And then consumer savings also, with interest rates rising, the interest that's paid to them going up, you have more spending. I think it's a unique confluence of events that certainly did make this time a little bit different.
Yeah, and that's clear that this time is definitely different because of the amount of debt at the sovereign level. But if you look underneath the surface, there are still issues that are arising when it comes to higher interest rates. You see delinquencies on credit cards rising, on auto loans rising. But job growth while slowing, still remains robust. And but you are seeing on the low end of the spectrum, income spectrum, that's where the consumer is hurting. You see that with the 99-cent stores. Go look at Dollar Tree and those stocks, and they're not doing very well because those lower end consumers, they don't have the fixed rates mortgage that most of the middle and upper income consumers have. And they're paying rents, and rental prices continue to go up. So this is a very different environment. And so that's why I say, are higher rates actually inflationary? Because at the end of the day, when interest rates go up, when the Fed raises rates from 0 to 5, and the Fed or the Treasury continues to issue on the short end, right? That means every year interest payments continue to rise, and those interest payments are government spending. And if you do a GDP calculation, if you go to Econ 101 in college, the first thing you pretty much learn is the calculation of GDP, and in there is government spending. And so ultimately, higher rates are just driving more government spending and not really impacting the vast majority of Americans. Some Americans, yes, and some parts of the economy that are super interest rate sensitive, but for the most part, it's just putting more money in people's pockets. And so, will the Fed, my question is, where is that tipping point? Because they have fixed mortgage rates. That's not going to change, right? Most of these people refinanced over the last 10 years. That means for at least another 10, 20 years, they're going to be locked into those rates. And so I actually think that the Fed's going to see rising interest rates isn't going to solve anything. And that's why maybe, just maybe, Luke, the market's right that we won't get any cuts this year. It will just be an eventual resumption of rate increases, which would be definitely this time is different because typically you get 6 to 12 months of a pause of the last rate hike before, and then you get a series of cuts. We might see 6 to 12 months of a pause and then a resumption of those rate increases. And that's why I think the 10-year continues to kind of march back towards that 5% rate, because ultimately, no matter what way you look, you kind of see inflation. Where do you get a deflationary environment? I don't know if you do, unless you get the government to stop spending. That's the only deflationary environment that I could see manifesting. Can you see another one?
I mean, certainly with what's going on a macro scale and geopolitically, I don't think without the government propping this up, that you would move to a situation where costs start narrowing, where the gap starts narrowing.
Now let's swing back to the InvestTalk voice bank for a question that came in earlier from a listener in Ohio.
Hello, Justin, Luke, and Steve. This is Bob from Ohio, and I'm calling about Amazon, ticker AMZN. I'm a long-term bull on Amazon, and I think they've created a huge business mode and practically monopolized the shopping environment. Since I'm a long-term bull, I was overweight my initial position to about 10%. Now, with the recent run-up, it's climbed to about 18% of my total portfolio. I know I should sell, but my question is, should I sell it back to the original 10% or sell the whole portfolio or the whole position? Thanks for what you guys do, and I look forward to hearing your answer on the podcast.
We'll definitely want to sell it back to the 10%. And frankly, I would probably go lower, closer to 5%. I wouldn't sell the entire thing. Amazon's still a good business. It has clean balance sheet. But look, it is trading at a pretty high multiple, would you say?
It's trading at a really high price earnings multiple. It's at 40 right now, at about 40. There's also some regulatory risk there, right? Like Amazon is in a situation where there could be some pretty adverse consequences on the horizon. But regardless of what the company is, 10% is way too much idiosyncratic risk in your portfolio. That is way too high a target weight for any company in your portfolio.
And I would say the technicals are starting to slow. MACD's rolled over. Momentum is certainly slowing, and it's happening across the tech space. If you just look at like the XLK, that's been underperforming the broader market really since February, and so you're definitely getting a drag there, and obviously Amazon is caught up in that. And so I definitely would trim Like Luke said, it's trading a high multiple. There's a lot of regulatory risk with what's happening at the Department of no, sorry, not the Department, the FTC, Federal Trade Commission. You see them suing Apple, Google, and I'm sure Amazon is certainly next as well. I think they officially filed against Amazon. I know they were talking about it. I can't remember.
I don't know if they've officially filed yet.
Okay. Yeah, there's definitely some antitrust practices that need to be cracked down on in Amazon with using their data to undermine their competition, those that are posting on Amazon. So, being a seller and owning the platform, that's causing a lot of conflicts. And so certainly a lot of regulatory risk on Amazon's front as well. So I would trim to probably 5% of your portfolio, and this is a good time to do it. Now, here's another question that came in from our InvestTalk YouTube channel. Mike McFadden says, what resources, metrics can investors use to evaluate money managers? Would these tools have painted a clearer picture from ARK management under Cathie Wood? Well, the first is the process. I always go back to when it comes to equity investing, the most important factor is going to be the quality of businesses that they invest in. And the question is, are they doing that? And it can be growth companies. It can be companies that are growing, but are they profitable? Are they producing good cash flow? Do they have solid balance sheets, et cetera? And I think that's the basis for all good investment strategies. What would you use, Luke? How would you answer this question?
Yeah, well, I think it depends, right? I think you should be choosing money managers whose philosophies align with your own. And that philosophy shouldn't just be they had really good returns that one year.
Yeah.
Because it's about consistency, of returns and risk-adjusted returns. What are the returns relative to the volatility and risk they're taking on in that portfolio? And so a lot of investors saw how ARK did with some pretty bad businesses that did well in a very unique scenario. And they said, those returns are great.
And over a very short period of time.
For a very short period of time.
Yeah.
And that's another thing. Length, track record, right?
Yeah.
If pensions, for example, won't even look at funds that don't have more than 3 to 5 years of performance.
Yep.
And so it should be a longer track record. It should be consistent. But more importantly, it should align with your own investment philosophy.
Yeah. And if you look at ARK, it did well for an extremely short period of time. You're talking about March of 2020, right when the pandemic hit. And then it peaked out in February of 2021. That was less than a year. It was basically 1 year where this bottomed at 32, hit a high of 158, and now it's back down to 45. And the vast majority of people got in near the end of that move, right? Well, when ARKK was, and what I'm looking at is the ARK Innovation ETF, the kind of their most popular ETF. And most people got in kind of near the end of 2020 when this was well over $100 per share. And so it's literally the epitome of a flash in the pan. And every strategy kind of ebbs and flows. That's certainly true. Every strategy is going to have its fantastic years and its, subpar years. That's fine. But if you're looking in aggregate and they have one great year and then a bunch of subpar years, was that luck or was that actually skill? Was that luck or were they actually allocating capital effectively, consistently? And ultimately, that was the red flag with Cathie Wood. ARK was launched in 2014, and outside of that time period, they've had subpar risk-adjusted returns, as Luke said. And that's what you want to look at. Not just total returns, but total returns in relation to the subsector that they're focusing on. For example, ARK is looking at growth stocks, okay? How is ARK done now compared to the NASDAQ, for example? It's done horribly, right? And so you want to look at it compared to similar types of strategies. Now, this is InvestTalk. I'm Justin Klein with Luke Guerrero, and we have one goal here each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Hello, InvestTalk. My name is Brian. I'm from Ohio. I've been a listener since about 2017. I love the show. I was wanting to know if you could review Pfizer. Ticker symbol is PFE. Just wanted you guys to review it to see what you guys thought of the stock heading into the future. Thank you.
This is the name that we keep getting calls on consistently over the past year plus, and it continues to go lower. And I keep saying, run away from it, mainly because the vaccines and the boosters, they don't work very well, and they have poor safety records. And so people are opting out of them. It's pretty clear. And, while we gave them blanket immunity here, are they going to get that in places like Europe? I think there's some risks there. mRNA platform just frankly doesn't have good safety records. And the more data comes in, the more that is supported. So Pfizer's earnings continue to drop, and I think they will continue to do so. Last quarter, revenue's down 41%, earnings down 90%. So run for the hills. Stay far, far away. Now, Luke, let's pivot over and talk about the housing bills that are moving through different legislative bodies across various states. And the goal here is to prevent companies like Invitation Homes from buying more and more single-family homes to rent across America and pricing out the first-time home buyer. So the question is, this is popular. Probably about an equal number of Democrats and Republicans support a measure that would block these Wall Street firms from buying these homes. And then the question would be, will they get passed, and will it have an impact? What do you think?
Well, it's funny to me because California being one of the states that's there's some lobbying effort to get legislation like this. When I used to live in Santa Monica, for example, and in the city of Santa Monica, you can't build homes that are higher than the home behind them to obstruct views. And so the cost of property in Santa Monica is exorbitant. The cost of renting anything that isn't a trash can in Santa Monica is exorbitant. And so it seems to me like this is kind of a boogeyman for what the real issue is, which is mortgage rates are high and we aren't building homes. And so people don't want to sell their home, and there's not a lot of inventory. Yet we're going out there and we're saying, oh, no, it's the big bad Wall Street firms are the ones causing this problem. So even if this were to pass, I don't think it solves the root of the issue, which is we just have not been building homes for nearly 2 decades.
I agree with that. However, the price of homes are priced at the margin, right? And research estimates that these companies, Wall Street companies, own about 3 to 5% of American rental homes, homes that are single-family homes that are being rented. And in some cities, it's very large. In Atlanta, nearly 11% of all rental homes in the 5-county area are now owned by one of the 3 major real estate companies. And a 2022 analysis said that 21% of Atlanta rental homes were owned by some large institution. That's a big chunk. So, will them divesting actually weigh on home prices? I think it absolutely will if it forces them to sell them in a short period of time, right? I think that will be the ultimate question. I think this will eventually pass in some states, maybe not nationally. There's a lot of lobbyists, obviously, within the industry. But the question will be how quickly do they need to divest them? If they own thousands of homes and they go and have to dump those and sell them within a year, that's going to have a very strong adverse effect on prices in that particular area. But if they have a decade to do it and get down to a reasonable number, then I could see this not really having much of an impact, or at least say a major impact. Some of these bills are limiting ownership to 50 homes per company. So that would basically put Invitation Homes, they would no longer be public, right? So I agree with you that there is a problem with just lack of homes being built. But when you have a large swath of areas being owned by companies that have higher access to capital, better access to capital, I think that certainly has a outsized impact on prices. Now, I'm Justin Klein, along with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.